Hey, hi, Heer. Welcome to this mock interview. So basically, how this mock interview is structured is basically Sarthak will assess your cultural fit in the team. So he'll be
Mhm.
asking you a bunch of behavioral interview questions, followed by certain technical questions, which will be purely based on what you have written in your resume. And we will also test certain subject matter expertise. I mean, because we feel like certain subjects like derivatives, fixed income, statistics, risk management, these are certain subjects which we feel are important for the job role. So I'll head over to Sarthak, and he'll take it from there.
Sure.
Mm.
Thank you, Mehul. Hello, Heer. Thank you for doing your application with us. We really like your resume. First of all, I would like you to walk us through your resume.
Mm-hmm. Got it. So I have done my undergrad in information technology and my master's in quant finance from Rutgers. I have worked on several projects like automating certain company functionalities with Python. In the DeFi and the cryptocurrency domain, I have worked on several on-chain analytics projects, and I have played around with evaluating different protocols. I also have experience with several risk management techniques and exotic financial instruments with projects around interest rate modeling, Monte Carlo simulations, and predicting credit default risk.
Great. Thank you. To start, I just want you to tell me about a situation where you had a disagreement with a colleague or a team member.
Got it. So this is about the time when I was working at Deloitte India, and here most of my task was creating reports based on our findings of the macroeconomic indicators that we were researching, and these indicators were based on the short-term and the long-term economic outlook. And there were instances when sometimes the indicators that each one of us were researching on were supposed to correlate in a specific way were not correlating as they should have. So we had to backtrack and uh, take a look at what went wrong. Was there something that we did or misunderstood in the research that we were doing? For example, there was a time when we were working with the government fiscal deficit and the account deficit, and these features were not correlating because of an overnight demonetization situation in which the short-term economic outlook was heavily impacted, but the long-term economic outlook was not impacted as much. So we just had to look into displaying our results using a time shift overlay graphs in our report.
Sure, thank you. I would like to go to the next question, which is like describe a challenging problem you faced in a project and how did you approach solving it and what was the result?
Got it. So during my time at IIFL Securities, I worked mainly on automating the market research of data. So the way that we were extracting the market research was very manual, and we did not make use of any programming languages. For example, what I did was I tried to integrate the Python Beautiful Soup library to manually extract the news articles from the APIs that we were using. And using Beautiful Soup library, this project was eventually taken up by the seniors to integrate it with the Ion workflow of the trading order book management platform. So that is where that ended up.
Great. Uh, and moving to the next question, can you tell me about a time when you had to uh, took on a leadership role in a project and how did you motivate and guide your team or the team members to achieve the project goals?
Got it. Uh, So, during my master's in quant finance program, there were a lot of projects that we worked on for the different courses that we took. So, one such course was statistics and machine learning. And in this particular course, we were basically working on a project in which we were trying to get the behavioral and sentiment analysis of the founders of the startups. So here in this project, I was mainly involved in collaborating with my team members, and we had to communicate on a day-to-day basis because it was a very lengthy project. So yeah, this was one such project in which I displayed some leadership.
Great. Moving to the next question, how do you prioritize tasks when working on multiple projects? Can you give me an example of a time when you successfully manage completing deadlines when multiple projects were colliding with each other?
Got it. Yes, again during my master's program, so it was quite a lengthy and a hectic program. We had to complete 45 credits worth of coursework within a year and a half or 2 years, and most of the times a lot of things overlapped. We were working with a lot of assignments. We were working with projects, and there are times when we get interviews as well. So we need to manage a lot of that as well. So the things that I used to consider was just prioritize what are the things that are the most important for my career aspect, and try to just keep doing things and try to keep finishing the tasks on a day-to-day basis and not postpone or procrastinate on anything.
That's great. Now Mehul will take over for the technical round. Thank you for your time.
Yeah, sure. Thank you, Sarthak. That's great. Here, good to know about, of course, your master's program. It's way too hectic, and I guess this is one thing I always hear from international students. It's like different shocks, educational shock, culture shock. So I totally relate it with you. So moving on, here, like I have a few statistics question which I wanted to ask you. So can you tell me like what is central limit theorem?
Got it. So central limit theorem is basically it basically tells us that the distribution of the sum of large numbers of the IIDs, which is the independent and identically distributed variables, will be approximately normally distributed regardless of the original distribution of the variables.
Okay, perfect. Also, like, what are the properties of a normal distribution?
Got it. So I have worked with normal distribution for quite a lot of projects. And for example, the easiest one is basically that the normal distribution is symmetrical,
Hmm.
and symmetrical as in it is perfectly symmetrical around the mean. The median, and mode for the normal distribution are also equal and located at the center of the distribution. It's also known as the bell-shaped curve, and there's also the standard deviations. For example, the first standard deviation would measure the 68% of the data. The second would look into the 95% of the data, and the third would be somewhere around 99.5% of the data.
Perfect, perfect. Also, do you know like what is law of large number and how it is utilized in quant finance?
Got it. So, law of large number is a is basically a theory which helps us to look into the Monte Carlo simulations as well. So it basically states that the average of results obtained from a large number of trials should be close to the expected value, and as the number of trials increase, the results will basically converge to the expected value.
Perfect, perfect. Yeah, that's correct. So, what is skewness and kurtosis?
Got it. So, if we talk about, let's say, normal distribution, the normal distribution has a kurtosis of 3, and it has a skewness of 0 because it is centered around the mean. And yeah, so skewness basically measures the asymmetry of the distribution. And let's say if we talk about the positive skew, so if the tail is on the right, it would mean that the mean mean is greater than the median, and which that is also greater than the mode, so that would eventually result in a positive skew. And kurtosis basically measures how fat the tails are.
Can you give an example of like how do we use kurtosis in finance or in quantitative finance or any of the models? Like how does it come like how do we use it, or like why is it important to understand kurtosis?
Got it. When we are calculating value at risks using Monte Carlo simulations, so we can either do it using normal distribution, or there are also different distributions that we can use. We can use, for example, log normal distributions to model interest rates, because we want to make sure that there are no negative data in the data set. And there is also this students t distribution which has a lot of kurtosis, and we can use that because, let's say, there are some complex derivatives which have a very unexpected payoff, and the payoffs are quite volatile. So all of these need to fit into the model, and all of this is accumulated by the kurtosses. So that's how it can be used.
Perfect, perfect. Also, like, if someone asks you to explain like what is null hypothesis and alternate hypothesis, how would you go about that?
Got it. So let's say we are trying to look into the coefficients of a linear regression model, and we want to see if the coefficients are statistically significant or are statistically insignificant. We would look into the null hypothesis and the alternative hypothesis, and based on the t stat that we find, we can either reject the null hypothesis or fail to reject the null hypothesis, and we could conclude the significance of our model.
So you said using t-stat.
Yes, t stat, or yeah, probably t stat.
Okay, so can you tell like how using t-stat will we be able to reject or accept any null hypothesis?
Got it. So I don't remember the exact formula, but I think we look at the t stat and the critical value based on the confidence interval, and if t stat is greater than the critical value, we would reject the null hypothesis.
Okay, perfect, perfect. So this was all about statistics that I had. Will jump into your resume. So I did see that you have worked on certain quantitative pricing and risk management projects for pricing interest rate derivative. So can you highlight that project? Like, what did you work on? What was the objective of the project? The task you worked on in the specific project?
Got it. Yeah, so this was basically, like you mentioned, pricing and risk management of interest rate derivatives. I modeled different interest rate derivatives like FRAs, swaps, FRNs, and accrual notes. I mainly used Python to fit the Vasicek models, and I also performed Monte Carlo simulations to price these complex instruments. And after all of that, I conducted sensitivity analysis to examine how basically the payoffs of these interest rate derivatives would change with different instruments.
Right. So can you elaborate like what is FASI-check interest rate model and how do we use it to simulate interest rates?
Got it. So, Vasicek interest rate model is basically a short-term interest rate model, and it is a mean reverting model, which basically ensures that it captures the mean reverting feature of the interest rates. And the formula for the Vasicek model is basically, let's say, the DRT is the short-term interest rate equals to A into B minus RTDT plus volatility into the Wiener process, which basically accounts for the randomness in the interest rate modeling. And A would be basically the speed of mean reversion, and B would be the long term mean.
Right, right, right. So what do you mean by mean reverting property? Like what is it?
Got it. So the model assumes that over a long period of time, if the interest rates have deviated from the long-term historical mean, they are they are they are assumed to return to the mean level over a period of time again.
Right, right, right. So you mentioned about the Wiener process, or we can also say that as Brownian motion. So can you tell me like what are the properties of Brownian motion?
Got it. So the properties of Brownian motion. So the first one being the independent increments. So the increments of the process don't overlap over the time intervals. Also, the increments are normally distributed. It also has a Markov property, and yeah, it has continuous paths with no jumps.
Okay. Any other property that you think you might be missing?
Independent increment.
So one property is that it starts with zero. If you That's why if you see B naught or let's say the Brownian motion always starts from zero.
Mhm.
Yeah. And when you mention about the Markov process, you mention about being it Markov. What do you mean by that?
Yeah, so that basically means that the future behavior would depend only on the current position, but not the past history.
Right. Can you give an example of Markov property?
An example, so for example, what could be? Yeah, let's say we are trying to price a stock which we want to model on the Markov process. So for that, it would basically mean that the future price would depend on the current price and not on the sequences of the historical data that we have.
Right, perfect. Like if you see any stock price, I mean, if we have the price of today, it basically
Mhm.
captures whatever happened in the history, right? So yeah, that can be one example. Yeah, that's good. That's good. So can you explain like what a forward rate agreement is and how it functions in context with interest rate risk management?
Got it. Yeah, so FRAs are basically interest rate derivatives instruments, and they lock in an interest rate for a future period wherein wherein we can try to hedge the interest rate risk. So basically, the payoff of this is also based on the difference between the agreed fixed rate and the actual rate at the settlement.
Okay. Okay. So is it like so like how did you use the like how did you price FRA is what I'm trying to understand. Like
Got it. So,
you have an
yeah.
FRA, you have check interest rate models. How did you price it?
Got it. So let's just start from the beginning. So with the Vasicek interest rate models, I tried to initialize the parameters by minimizing the sum of squared errors for the objective function, and that was basically minimizing the theoretical parameters and the historical parameters. And once I had the initial parameters, I used the Vasicek model to simulate the rate, and once I was done simulating the rate, I tried to perform Monte Carlo simulations wherein I use different distributions. For example, like I mentioned before, I used the normal distribution as well as the log normal distribution. And once I was done with the Monte Carlo simulations, for each of the path that I each path that I had, I tried to calculate the payoffs of each of the path. For example, uh, uh, for each path I calculated the forecasted rate, and based on the forecasted rate, there's this formula for the FRA payoff, which is forecasted rate minus fixed rate into the notional amount into the time to maturity divided by 1 plus discounted rate into again the time to maturity. So that's how I calculated it, and eventually when I had the payoffs for all the different parts, I took an average to price that particular FR.
Okay, perfect. Okay, perfect. So a couple of quick question on you mentioned about calibrating the parameter, right? And you said you took the sum of difference and tried to minimize it. So what was the underlying that you were considering? Which interest rate underlying were you considering?
So I'm sorry, I didn't get the
Okay,
question
so
exactly.
let's say yeah, yeah. Let's
Yeah.
say so let's say your forward rate agreement, was it a software agreement or a US Treasury agreement? What agreement was it?
Yes, it was a US Treasury agreement.
Okay, so if it was a US Treasury agreement, which US Treasury rates you were considering? Was it a 3 month rate, 6 month rate, 1 year rate? Like which
Got
interest rate one were you considering and why?
Yeah, so I was basically using the 6 month interest rate, but as per the question why, there were no preferences made to the 6 month interest rate. I was just doing it to learn as much as possible about the IRD modeling, so I just chose the first thing that came to my mind.
And how long is your forward rate agreement? Like,
So I think it was 9 by 12.
so what do you mean by 9 by 12?
So basically, from 9 months from now for the another 3 months.
Okay, perfect. Cool. So moving on, so you mentioned about just one second. Okay, so what are the key differences between FRAs and other interest rate derivatives such as interest rate swaps or futures?
Got it. I already mentioned the definition for FRAs, but if we talk about swaps are it is basically a financial derivative in which two parties exchange the cash flows or liabilities from two different financial instruments. And the way you calculate the payoffs for swap is basically you calculate the present value of the fixed leg and the present value of the floating leg of the cash flows, and you try to get the difference between them.
Okay, perfect. Yeah, sounds good. So and same for like so you mentioned like you use swaps, right? So is it like similar setting? Like how did you use your interest rate model for swaps if you can give a surface level understanding?
Got it. Yeah, so that was again similarly the way I did it for FRAs. I fit the Vasicek model, and I again did the Monte Carlo simulation for a number of trials. And for each and every trial, I tried to get the payoff for that particular swap. I discounted it to present values, and then I took the average.
Right. Because okay, so if I ask you to explain Monte Carlo in easy language, how would you explain it? Like what is Monte Carlo?
Got it. So Monte Carlo simulations are basically, let's say you generate an initial random variables, and anything that you want to model. So if we consider the interest rates, let's say there is an interest rate path that you have, and that interest rate path you want to see how much it can vary, what the variance can be, how spread out it can be in the worst case scenarios. So for that you look into model it using Monte Carlo simulations.
So basically, Monte Carlo is used to predict the uncertainty, right? In simple terms.
Yeah.
Okay.
Yeah.
So when we use Monte Carlo, we all know that, it generates error. More and more you simulate your, let's say, interest rate part or be it any parts, right?
Mhm.
Even if it's stock price or anything, it will generate a different, it will generate errors. How would
Mhm.
you mitigate those errors, like the Monte Carlo errors? How would you minimize those errors?
Got it. So the errors for Monte Carlo. So could we possibly try some variance reduction techniques?
Right,
I'm not I'm not sure what these and there are these antithetic variates and the control variates. I'm
right.
not exactly sure how they work, but I'm aware that these are some variance reduction techniques, and we
Yeah.
could use.
You are correct. Anti-static is nothing but let's say if you are generating your paths, you generate like two, I mean you generate two paths which are like symmetrical. So if you're joining plus W, so you'll generate one more path which will be minus W. W is nothing but your Wiener process. So you'll be
Yeah.
generating like opposite, so opposite paths, like
Mhm.
opposite random variables you can say. So this will
Mhm.
actually help you to mitigate the error.
Got it.
Yeah, okay, no worries. So moving on to your risk analysis and Monte Carlo simulation project of the corporate bond. Can you walk me through what was the project?
Yes. So basically, it was performing Monte Carlo simulations and analyzing the risk of a corporate bond portfolio. And I had data set of a lot of corporate bonds wherein I had, yeah, the basic features, the coupon rates, the maturities, the face value, the present value, the YTM. And I conducted a lot of data pre-processing, and I looked into analyzing a lot of risk factors such as primarily the interest rate risk using different methodologies like duration analysis. I also tried to conduct the yield curve scenario analysis by integrating some interpolation techniques. And eventually, I used Monte Carlo simulations to look into the key metrics such as VAR and conditional VAR.
Okay. Actually, I was little confused. So you mentioned you had a corporate bond and then
Mhm.
basically you work on cleaning of the data set. And
Mhm.
then, like, what did you compute for from that corporate bond data? What was there any key risk measures that you were computing, or you just did data cleaning?
No, actually, so there was a corporate bond portfolio. So in that portfolio, there were a lot of corporate bonds, and for that particular portfolio, I looked into the weighted average duration. I looked into the convexity of portfolio so that I could look into the portfolio sensitivity towards the interest rate risk. I also conducted yield curve scenario analysis. For example, I looked into, let's say, the parallel shifts, or also the steepening of the yield curve, or the flattening of the yield curve, and how that would affect my portfolio. And for the Monte Carlo simulation part, I performed the Monte Carlo simulation for my portfolio returns, and I tried to calculate the VAR and the conditional VAR.
Perfect. Sorry. I was little confused in the first time. Sorry, but you did not. It was not your fault. Yeah, I was reading your resume. Can you tell me what is duration and what is convexity?
Got it. So duration, basically there are two durations. One is the Macaulay's duration and one is the modified duration. The MACD basically calculates the weighted average time it takes to receive all the cash flows from a particular bond, and the modified duration is mainly used to calculate the interest rate sensitivity towards a particular bond portfolio. And I'm sorry, did you ask about convexity as well?
Yeah.
Yeah. So convexity is basically used to measure the second order derivative of interest rate sensitivity. For example, the duration is a very linear measure and it does not account for large changes in the yield. And the convexity takes into account the curvature of the yield price relationship as well.
Perfect. So let's say if I give you two different bond, one is the zero coupon bond, and the maturity is 5 years, and the second one is 5% paying coupon bond. Again, the maturity is 5 years, which will have a higher interest rate risk.
Yeah, so definitely the zero coupon bond will have the highest interest rate risk because the weighted average time is much more longer, and when you are paying out the coupons, the average time to get all the cash flows decreases. So as the duration of the zero coupon bonds is the highest, that it will be more sensitive to the interest rate risk.
Okay, so let's say if I give you if I give you two bond in a portfolio, right? Can you walk me through the steps of how to calculate duration for that?
Uh, yeah, so basically, first we measure the weight of the first bond in the portfolio and we calculate the duration of that. And yeah, it's basically calculating a weighted duration. We calculate the weight weight of that particular bond towards the entire portfolio multiplied by its its duration, and we add the weight of the other bond uh, relative to the portfolio and multiply it with its duration and basically
Right.
sum it.
Yeah, I agree. It's like weighted average for a duration. I totally agree. So duration of portfolio is W is equal to W1 D1 plus W2 D2. I agree. But how will you
Mhm.
calculate D1? Let's say if I ask you for a bond, how will you calculate the duration?
Okay, got it. So, do you mean the formula for the duration?
Yeah. The formula, or if you can just walk me through the step, I'm totally fine with it. Yeah.
Got it. So let's say there are different coupons for that particular bond. So we will basically calculate the present value of those coupons plus the present value uh, uh, of the payments on the time of maturity, and we will divide it by the current bond price for the Macaulay's duration, and for the modified duration, we will basically divide the Macaulay's duration by one plus the YTM.
Perfect. Yeah, that sounds good, man. That's a great answer. So you mentioned you use couple of interpolation techniques. Can you elaborate on that?
Got it. So I'm only familiar with the linear interpolation technique. So
Okay.
for what I did for the yield curve analysis was basically based on the historical data that I had, I defined the initial yield curve with the maturities and the yield. And once I had the initial yield curve, I fit a Python-based interpolation function to this yield curve. And what I used was basically the inter PLD library from SciPy to fit this linear interpolation on the yield curve. And once I had interpolated that particular yield curve, I created different functions for, like I mentioned before, the steepening of the yield curve or the flattening of the yield curve. And based on that, I again priced the entire portfolio.
Okay. So let's say, let me share my whiteboard. Let me know if you can see it.
Mm-hmm.
So let's say we have different points like this, okay? Something like this. So let's say if I want to draw a linear interpolation, okay? How will I draw between these two lines?
Actually, I can't see any of the two lines that
Okay,
you've drawn.
okay, so let's say this is one point. This is the second point. Can you see my whiteboard? Can everyone see my
Uh,
whiteboard?
I can see. Okay, got it. Yeah, I had to zoom in into that
Okay.
particular.
Okay. So how will you draw a linear interpolation between these two lines, between these two points?
Got it.
So let's say this is your third point. Something
Mm-hmm.
have your yield curve, something like this. How will you draw a linear interpolation?
Mm, I don't think. So visually, I'm not sure about how that works. I only had theoretical knowledge of it, but I'm trying to think as to what I
Yeah.
could be looking
Yeah,
for.
take your time. I mean, you take your time. Yeah. So basically, I'll just tell you. See, we know linear interpolation is nothing but it's same as if you see linear regression. If you see linear regression, because that's where they are pulling the name, right? Linear regression is a
Yeah,
straight line, right?
yeah,
Linear
best fit.
straight line, right? So what we'll do is we'll just draw a straight line between these two points. We'll just draw a straight line in between all the points. That's it.
Mhm.
So that's how you basically draw a linear interpolation. But because or if you see like straight line is not the best way because it does not capture the non-linearity, right? And if we
Mhm.
see, I mean, let's say if you see the 30-year maturity, there will be, it won't be linear anymore, right? Let's say if it's here, somewhere here, right? If you draw
Yeah.
something like this, it is not correct. And that's why, methods like B-spline or cubic spline, these came into existence. So this is just for your
Got
knowledge, but you were good on the
got
explanation part, yeah.
got it. Got it.
Uh, Okay, so just let me exit this. Okay, let me reopen your resume. Okay, so um, so you mentioned about generating Monte Carlo simulation. So how did you use Monte Carlo simulation? If you can walk me through that.
Got it. So for the entire portfolio, initially, I'm sorry. I defined a holding period of 10 days and a 99% confidence interval. And then for 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 modeling the historical interest rates, I calculated the mean and the standard deviation, and then I generated the random interest rate scenarios using the basic numpy dot random dot normal and also the random dot log normal. And for each scenario, I calculated the new price of the corporate bonds in the portfolio, and also I looked at the changes in the values of the portfolio, and then I calculated the portfolio returns for each simulation. And now I had a numpy array for the returns of the portfolio, so I sorted the numpy arrays, and I eventually calculated the var and the conditional var.
Okay, so okay, what are some of the limitations of value at risk?
Got it. So value at risk, I believe it is not additive. So I think that would be one of the limitations for that. Also, when we talk about value at risk, we do not capture the tail risk that is captured by the conditional var. So that is also one of the limitations. And there are a lot of different methods to calculate the value at risk. So we couldn't be sure as to which method are giving us the best results, as different methods could also evaluate different results.
Okay, perfect. So when will you when just I'm just curious when will because the three methods are variance, covariance, historical, and Monte Carlo. So when will
Mhm.
we use the Monte Carlo method for
Got it.
which instrument?
So,
Yes.
got it. So variance, the variance covariance method, which is the parametric method, in which you basically multiply by the z score. So that method is not suitable when the instruments are non-linear in nature. For example, that particular method is only used to model linear instruments. So when the instruments are a bit more tricky, I think we could use the Monte Carlo simulation.
Yeah, can you give me an example of what are linear instruments or what are non-linear instruments?
Got it. So, linear instruments could basically be a portfolio of just normal stocks and bonds, and non-linear instruments we could be talking about exotics and interest rate derivatives like the swaps, the caps, the floors, and for example, some convertible bonds as well.
What do you think forwards and futures, are they linear instruments or are they non-linear instruments?
Forwards and futures, I mean, the payoffs would be pretty straightforward for that. So the futures are pretty standardized. So I think the futures are linear instruments, but forwards could be customized as per the parties. So I think there might be a little bit of a gray area in that.
I mean, yeah, I mean, but okay, I agree. But mostly, when we draw the payoff diagram, if you see, it's just a straight line up or
Yeah,
straight line down, right? So generally, we say that as linear. But if you
got
see options, options are something like this, or
it.
some like it will move in, various. I mean, it's straight line and then it will go up. So if you see, it's not linear because what we say linear as straight line, but this becomes static and then it goes like this. So that's why we say like options and what you mentioned exotic options are those are non-linear. So you are totally correct on that.
Got it.
So coming on to your last project, which is credit default project. Can you walk me through what is the project and what did you do?
Got it. So this was much more of a data science and data pre-processing oriented project. And in this project, like I mentioned, data pre-processing, I looked into a lot of missing values. I did a lot of outlier detection. I did log transformation because I was modeling it on logistic regression. I also conducted standardization for SVM. I did perform PCA for dimensionality reduction, and eventually I ended up doing data visualization to look at the relationships between feature. And I was modeling basically the probability of default, and I did that using, like I mentioned, SVM and logistic regression. And I also looked into some different evaluation matrix like AUC, ROC, precision, recall, and F1 score.
Okay. So you mentioned you use principal component analysis or PCA to reduce your dimension, right? So
Mhm.
so you wrote that you reduce it to four principal components. My question is, how would you understand which, because when you reduce it to the principal components, you actually lose out. Of course, the information is captured, but then you lose out on the information of what is the variable, right? So
Yeah.
PC1, PC2, PC till like PC4, how would you understand like which principal component is like what?
Got it. Yeah, so I understand that the principal component analysis is essentially a black box, and I did dimensionality reduction using PCA because I just wanted to learn more about it and see how it affects my data. And for to answer your question, I was looking at one research paper in which they were mentioning the usage of a loading function. So basically, that's what I just straight up. Took it from, and I just used that loading function, and that particular loading function would basically represent the coefficient of the original features in the linear combination, and how much each of the coefficients were contributing to the variance of the PCA. So I just used that loading function from a research paper.
Okay, perfect. How would you test for collinearity? Like, is there any statistical test that you use?
So for multicollinearity, I did not uh, test for multicollinearity in this particular project, but when talking about regressions, I think there is this particular test called the variance inflation factor test that calculates, I think, the multicollinearity between the features.
Yeah. So like, let's say if you get a VIF of 7, what would you say about the variable?
A VI of 7. I'm sorry, I'm not sure what I would say. I'm not sure about the range of the VIF test, so uh, I'm not sure about that.
Okay, no problem. Okay, just to correct you, you have written about the multi-goal linearity. So this is just wanted to I just wanted to give you a heads up. Okay. So you wrote about logistic regression, and we all know logistic is nothing but, I mean, it came after, linear regression. So I'm just curious, like, what are the assumptions of linear regression?
Got it. So the basically the first and the simplest assumption is the linearity assumption. There is also a homoscedasticity assumption, which basically tells us that the variance of the error terms is constant. There is also the normality assumption. There is also a no multicollinearity assumption. And apart from all that, mm, I think there were one or two more, but I'm not able to
Yeah.
recollect those.
Yeah, so when can be, the dependent and independent variables are
Mhm.
linear in nature.
Mhm.
Second is autocorrelation between residual, that is, there should be no autocorrelation between the residual. Third is
Yeah.
heteroscedasticity, that there should be no heteroscedasticity.
Okay.
Fourth is, I guess, multicollinearity, which you already mentioned, and last is about the distribution. So
Mhm.
you yeah. Um, let's say you have two variables, and they both are let's say they both are collinear, right? They have higher multicollinearity. How will you
Mhm.
know which one to drop, which variable to drop?
So does the entire data set have just two variables, or we're picking out of these two variables?
So basically, let's say you have two variables, and they have, like, they have, of course, they are similar, but they have like, they're, like, you can say they have 90% correlation. So
Okay.
so putting both the variables in the model does not make sense, because essentially 90% of the data is just the same. So how would you go about it? How would you understand which variable to consider and which to reject?
Got it. So two variables, and we're looking to drop one. No correlation. They are correlating a lot. What can we look at? So could we conduct a residual analysis while modeling each variable separately and see which model is giving a better score and
Yeah,
just
so that
pick.
yeah, that's a great answer. What we can do is we can run a linear regression model, keeping one variable, let's
Mhm.
say V1, and removing the second variable, and then
Mhm.
again we'll run a linear regression, removing V1 and keeping the second variable V2, and that's how
Mhm.
you get to know, okay, which model is performing better, and that's how you get to know, okay, this is what we need to keep. So you were good on that. Let's say
Got it.
for your logistic regression model, how would you understand your under if your model is suffering underfitting or overfitting?
Got it. So logistic regression model is basically modeling the sigmoid function, and for the underfitting, there are basically some of the indicators in which we can look at the bias. So I think if the bias is pretty high, and there are high error rates on both the training and the testing data, we could say that there is some underfitting. And for overfitting, we could look at the variances, and if there is high variance on the fitted data, there would be overfitting.
Are you sure on that?
uh, the underfitting part or the overfitting part?
The overfitting part.
Okay. So high variance would basically, mm, yeah, I think high variance would indicate overfitting based on a
Yeah,
logistic regression model.
yeah, I was just messing around. No, you are good. You are good. Yeah. So so
No.
so moving on. Let's say, how would you define AUC ROC curve? Like, what is the curve, and how would you define it?
So AUC ROC is basically best used to distinguish between uh, classes and binary classes for modeling those, and that curve is basically the area under the curve for the, I don't remember the full form for ROC, but it ROC curve basically plots the true positive rate against the false positive rate.
Right, right. Just curious on that, like let's say for logistic regression, we always mention that zero point 0.5 is the indication, right? If your
Mhm.
value is less than zero point 0.5, it is 0, and if it's greater than zero point 0.5, it is 1. But you
Mhm.
know, in the industry, it's not always zero point 0.5. We can take like zero point 0.8, right?
Mhm.
Because sometimes what will happen is we do not want to reject any borrower because we know that okay, this borrower, even though he might default, but the chances are less likely, the probability is really low. So like, do you know how to understand what number to keep? Like, is it 0.5, 0.7, 0.8, 0.9? Like, how would you understand that?
Got it. So I think it would require a lot of expertise and experience to determine the threshold. Basically, just making sure that you have a lot of experience modeling that particular scenario. I'm trying to think about a theoretical way to do it,
So you can
but
also do via modeling also. So
mhm, got it. Uh, so theoretically,
So what you can do is, and this is one concept from the industry, is let's say let's keep zero point 0.7, right? Okay, less than zero point 0.7 is 0 and greater than zero point 0.7 is 1, right? So you will
mhm,
check at zero point 0.7 how much loss you're, because let's say credit risk is nothing but you are trying to understand the probability of default, right? If
yeah,
the borrower default, how much will be the loss? So what you
mhm,
will do, you'll do at different points, zero point 0.7, 0.75, zero point 0.8, and then you will analyze what is the loss that your financial, let's say the financial institution or the portfolio can face. And if you see, okay, the loss is less, but suddenly it jumps, or it's way too much, then we need to evaluate the number. But so you can actually try and test different numbers and check, okay, how much loss your portfolio is facing. um, so sometimes what happens is when we are working on these machine learning models, it happens that the population changes. And what I mean by that is, let's say if you see pre-COVID era, times were
mhm,
different, post COVID era times were different, right? So the population, their nature, behavior changes. How would you go about it? Let's say you build a model which was on 20, let's say 20, it was from the year 2016 to 2020, and you are using 2021 data to predict, right, for the modeling piece. But how would you understand
okay,
if the population are still the same, or they have changed?
got it. So so you are asking me basically, there is always a lot of population on the data over the years. How I would predict the change in the population and the size of the data set,
No, no, I'm not
because
asking you. No, no, I'm not asking you to predict the change. I'm asking you, there is a statistical test which basically tells you if the nature of the population has shifted or not, right? If let's say the
got
nature has shifted, because if the nature of the population shifts, you cannot use the same model, right? Because what you assume is, okay, if let's say you have trained your model from 2015 to 2020, you will expect the
mhm,
population to behave the same manner in the future also. And that is like one of the key assumption we took in machine learning, right? Whatever
got
happened
it.
in the past, we using that, we'll train the model and try to fit in predict the future. So, but if the population change, the nature of the population changes, we cannot use the model. Yeah.
So could we look at p-value?
No, no, no. So I guess there's one test. I'll just message you, or I'll put it in the group. I'm not able to recollect, but this is one interview question that was actually asked to me, so I thought
Yeah.
of asking you.
Um, can I say that?
Yeah, Kumar, please go ahead.
Yeah, it's called Population Stability Index.
Oh, PSI, you
Basically,
are right. Yeah, he's
yeah,
right. Yeah. So
Got
population
it.
stability index is used to basically understand if the population is same, or the nature of the population has changed or not. So thanks,
Okay.
thanks, Kumar. Thank you so much.
yeah, no problem.
Okay. Uh, so moving on to your last project, the crypto project. Can you tell about what you worked on, and like what is the project on?
Got it. So, regarding the cryptocurrency industry, what I've done is I've mostly looked into a lot of different protocols, and I've analyzed the brass tacks of the cryptocurrency coins and the exchanges. And I haven't modeled any risk or quantitative methodologies in this particular industry. But let's say, for example, the coin market cap task, in that I basically tap the coin market cap API to get the data of this Lido protocol. And the Lido protocol had several different metrics, and I tried to analyze, let's say, for example, the market cap, the trading volume, the volatility of the token distribution, and also the holder concentration. And there are other protocols like the Aave protocol as well, which is basically a lending and borrowing platform. And in this, you deposit some of your crypto tokens into a liquidity pool to own some of the interest. And and if you are trying to borrow from that particular liquidity pool, you are supposed to provide a collateral. So all of this is basically DeFi based analysis, and I tried to look into liquidity risk, the collateral volatility risk, and also try to audit the smart contract history of this particular protocol.
Right, great, great. Actually, my background is not from crypto, so I'll just maybe I do not have any question. I'm sure like you worked on, you did a great project on crypto. So moving on, I have some questions on stochastic calculus. So do you know what is Ethos lemma?
Yeah, so Ito's lemma is basically, how can I frame that? It is basically a chain rule alternative of the normal calculus to stochastic calculus, and it is basically used to calculate the differential of a function of a stochastic process.
Right, right, right. And do you know what is Euler-Maruyama method and Milstein method?
Yeah, so I'm aware of the Euler-Maruyama method. So that is basically a numerical method, and that numerical analysis method. So let's say we have a CIR model, CIR interest rate derivatives model, and CIR model only has a closed form solution for modeling zero coupon bonds. For some complex instruments, the solution is not closed form. So to get a solution for that CIR model differential equation, we will have to discretize it based on an Euler-Maruyama method, which is basically separating into grid steps and time steps and discretizing at each small values.
Okay, perfect. And any idea about the Milstein method?
I'm sorry, I'm not aware of that method.
Okay. But thank you so much, Heer. You were fantastic. I don't have any other questions to be honest. I'll just stop the recording. But yeah, it was a great interview. Yeah.
Got it.